Imagine a life where your money works for you, not the other way around. This is the reality of financial freedom and passive income. Let that sink in for a moment. It's a tantalizing concept, isn't it? A life where you're not trading hours for dollars, but rather creating streams of income that flow to you even while you sleep. This is the power and allure of passive income. But what is passive income exactly? At its core, passive income refers to earnings derived from a rental property, limited partnership, or other enterprise in which a person is not actively involved. It's income that requires little to no effort to earn and maintain, a stark contrast to the active income that most of us are accustomed to. And why is passive income so important? Well, it's simple. It's all about freedom. Financial freedom, the freedom to live life on your terms, to pursue your passions, to spend more time with your loved ones, and to retire comfortably. It's about building wealth, not just making money. Enter Robert Kiyosaki, a financial expert and the author of the best-selling book, Rich Dad, Poor Dad. He's a staunch advocate for financial education and the pursuit of passive income. In his view, accumulating assets that generate passive income is the key to achieving financial freedom. He believes in creating multiple streams of passive income, each serving as a tributary feeding into the river of your wealth. Kiyosaki's philosophy is not about getting rich quick. It's about building sustainable wealth over time through smart, calculated decisions. It's about understanding the power of money and harnessing it to work for you. So buckle up, because we are going on an exciting journey into the world of passive income. We will explore various methods of generating passive income as recommended by Robert Kiyosaki himself. We'll discuss their potential benefits, their risks, and how you can get started. Now that you understand the power of passive income, let's delve into the methods recommended by Robert Kiyosaki. Peer-to-peer lending, an online platform where you lend money to investors in exchange for interest. Now let's delve into this fascinating world. Peer-to-peer lending, or P2P as it's commonly known, is a modern take on a practice as old as money itself: lending. But here's the twist. Instead of going through a bank, you're lending directly to individuals or small businesses via online platforms. What's the appeal here? Well, for starters, lower fees. Banks have overheads, buildings, staff, and all that jazz. P2P platforms operate online, meaning they're lean, mean lending machines. Lower costs for them can mean better interest rates for you, and then there's the risk factor. Sure, any type of lending carries risk. Someone might not pay you back. But P2P platforms have rigorous vetting processes, and most allow you to spread your investments across multiple loans, helping to mitigate that risk. But let's not get too carried away. Like any investment, it's important to do your homework and understand what you're getting into. While peer-to-peer lending can be lucrative, it's only one of many passive income methods. The real estate market, a traditional yet effective source of passive income. For centuries, it's been the go-to for those seeking a steady cash flow. And it's not hard to see why. With real estate, you're buying a tangible asset, a piece of the earth, if you will. And this asset has the potential to generate rental income month after month, year after year. But let's not forget about the appreciation potential. Over time, properties generally increase in value, which means not only are you making money from rent, but you're also building wealth as your property's value grows. That's a double whammy of profitability. Now, for those of you thinking, sounds great, but I don't have the time or the know-how to manage properties, there's another option. It's called a real estate investment trust, or REIT for short. These are companies that own, operate, or finance income-generating real estate. You can think of them like mutual funds for real estate. Investing in a REIT allows you to earn from real estate without having to buy or manage properties yourself. They're traded on major exchanges, just like stocks, and they're required by law to distribute at least 90% of their income to shareholders. That means steady, reliable dividends for you. But remember, while real estate and REITs can be great sources of passive income, they're not without risks. Property values can go down as well as up, and REITs are subject to market volatility. So it's crucial to do your homework and make informed decisions. Real estate is a time-tested method for passive income, but it's not the only game in town. Your creativity can be a gold mine with intellectual property rights. Often overlooked, intellectual property, or IP for short, is a compelling area of passive income. This sector circles around earning from patents, trademarks, copyrights, or even leveraging other people's creative ideas. Imagine inventing a product, writing a book, or creating a unique brand logo. Once these ideas are legally yours, any usage by others means money in your pocket. But it's not all sunshine and roses. There are risks involved. The process of securing these rights can be complex, and the outcome is not always guaranteed. It's a game of patience and resilience where the cost of protection must be weighed against potential returns. Still, the allure of intellectual property income is undeniable. One successful patent or copyright can generate a steady stream of income for years, even decades. Remember, the world is always hungry for new ideas and inventions, and if you can supply that demand, you just might strike gold. Intellectual property can be a lucrative source of passive income if managed well. Dividend stocks and businesses, the backbone of any passive income portfolio. Let's start with dividend stocks. These are shares in companies that distribute a portion of their profits back to shareholders, a sweet reward for your investment. Investing in dividend stocks is a fantastic way to generate passive income. They offer regular payouts, typically on a quarterly basis. These payments can serve as a steady income stream, or they can be reinvested to compound your wealth over time. Companies that have a history of stable and growing dividends are often mature and financially healthy, making them a reliable choice for investors seeking passive income. Now, onto businesses. The beauty of owning a business is that it can operate autonomously, generating income without your daily involvement. This could be a small business you've started yourself, or a larger enterprise you've invested in. Either way, the key is to have a competent team to manage day-to-day operations while you reap the benefits. Alternatively, passive investment in businesses is also a viable option. This could mean investing in a friend's startup or buying shares of a public company. The goal here is to put your money to work in businesses that you believe have potential for growth, without getting involved in the nitty-gritty of operations. But here's the golden nugget: diversification. Don't put all your eggs in one basket. Balance your portfolio with a mix of dividend stocks and businesses. This approach mitigates risk and creates multiple income streams, ensuring that if one area underperforms, you have others to fall back on. Remember, the road to financial freedom is paved with passive income. And in this journey, dividend stocks and businesses are not just companions, they're key players. Dividend stocks and businesses are key players in the passive income game. Annuities, a dependable source of retirement income with its own set of considerations. Let's delve into the world of annuities, shall we? Annuities are essentially contracts, typically with an insurance company, where you make an upfront payment or a series of payments. In return, the company agrees to make periodic payments to you, beginning immediately or at some future date. This can serve as a steady source of income during your retirement years. The potential of annuities as a form of passive income is quite significant. They offer a sense of security, as they can provide a consistent income stream for the rest of your life. There's a comforting predictability to it, knowing that every month, like clockwork, a specified amount will land in your account. But as with all things financial, it's not quite that simple. Annuities come with their own set of considerations. One of the big ones: inflation. It's crucial to remember that the purchasing power of a fixed payment will decrease over time due to inflation. So, if you're considering an annuity, make sure it's part of a larger, diverse investment strategy to hedge against this risk. And that brings us to a critical point: the importance of diversification and caution in all passive income endeavors. The world of finance is not a one-size-fits-all kind of place. What works for one person might not work for another. Therefore, it's essential to diversify your income sources. Don't put all your eggs in one basket. Having multiple passive income streams can offer you financial stability. If one source takes a hit, you have others to fall back on. And above all else, exercise caution. Do your research, understand the risks, and be prudent with your investments. Annuities can be a safe bet for retirement, but remember, diversification is key. Passive income can be your path to financial freedom, but like any journey, it requires careful planning and execution.